Hey guys, this is Nick with Nick Does DGI and welcome back to my channel. In today's video, I want to talk about something I experienced a few weeks ago during the height of the whole Wall Street bets, GameStop, hedge fund short squeeze saga, and what newer investors should take away from this. Hope you like this video and stay tuned. If you are new to my channel, I preach about my slow but consistent dividend growth investing approach, focusing on blue chip companies with proven track records of growing their profits and dividends year after year. The market closed in 2020 on a high note, recovering over 15% since its March 2020 lows, and 2021 appeared to continue that same narrative. The S&P 500 rose 4% during the first 3 weeks of January before quickly losing its gains over the following 3 trading days. What exactly happened during the last week of January? If you have been living under a rock, we witnessed a much publicized short squeeze battle between hedge funds and individual retail investors over GameStop, AMC, and other quote-unquote meme stocks. As hedge funds began to pile on losses, in order to cover their open short positions, billions of dollars invested in equities had to be sold, including many blue chip companies. And we saw millions of retail investors get shut out of their investing brokerages like Robinhood amidst the market volatility. And just to be clear, that was just a very simplified take on all this. If you want to learn more about what happened behind the scenes, there are plenty of other videos out there already on YouTube. Anyways, I started to watch the stock price of GameStop as more and more people in the finance space began to cover the whole ordeal. I remember I saw GameStop shares trading around $43 on January 20th. Seeing that it had already tripled in price since the beginning of the year, I did not expect the share price to rise much more. But boy, was I wrong. Within the next 3 days, GameStop stock blew up to a trading high of $514.50 on January 28th, and it was at that moment I experienced FOMO for the first time like never before. It was around January 28th when FOMO hit me hard. Despite being a so-called conservative investor, I suddenly had an urge for risk. FOMO, or fear of missing out, is a social anxiety defined as a fear of regret or missing out on an opportunity to earn profits. FOMO is applicable to a multitude of situations, but may prove to be dangerous to investors new and seasoned alike. I'll be the first to admit that FOMO tempted me so hard to a point where I was this close to putting in some money into GameStop to a tune of a few $1,000s without much of an investment thesis and merely on a speculative hunch in hopes of tripling my money. GameStop was trading roughly around $325 at this time, and many Wall Street subreddit posts were calling for a $1,000 price target if everyone just continued to practice having diamond hands, aka the practice of holding onto your meme stock shares no matter what the media says and what the share price does, until the hedge funds had their short positions squeezed out. Deep down inside, I began to start believing these online strangers, despite having absolutely zero knowledge about short squeezes, gamma squeezes, shorting, and what have you. But as January came and went, so did the hype around GameStop. I thought that these meme stocks would continue to be propped up so long as there are sufficient media coverage on this. Simply put, more media coverage meant more word of mouth and additional retail investor money being pumped in. Pulling up the Google Trends search for GameStop and Wall Street bets, media coverage for GameStop and the remaining meme stocks peaked on January 28th and has since drastically declined to where it had been prior to the run-up. And as the first week of February rolled around, we began to see a much different tone in the media coverage as GameStop share prices crashed more than 85% before stabilizing around $45 at the time of this recording. There was also extensive news coverage about individual retail investors buying high and left holding the bag while hedge funds have long exited their original positions. There were of course individuals who bought low and sold at the top, reaping in profits like no other. However, many more Reddit posts began to pop up showcasing serious losses incurred by new traders after risking their retirement savings or taking out personal loans just to get in on the hype. If you're wondering if I ended up getting in on some of the GameStop action, ultimately I did not, or else I would have lost more than 80% of my money. But lesson learned, at the end of the day, I felt that all of this was outside of my circle of competence and risk tolerance profile. My bread and butter is on dividend growth investing, and I will continue to prioritize building my dividend growth investing portfolio so I have a monthly passive income in the future. For those of you newer to the market and investing in general, be curious and continue to learn from these extraordinary events. It's completely awesome if you decide to go into individual stocks and make exponential returns on your investment. However, please keep in mind that it's not the norm to be hitting home runs out of the ballpark left and right, and I worry that newer or younger investors will have this new mindset of the stock market being some sort of money printer at a casino. At some point, all markets and economies will go through a prolonged bear market that will test every investor's patience and discipline. Market bubbles and speculations will come and go, but the market will continue to grow on average 9 to 10% annually. Dividend growth investing continues to have some clout. For example, Dividend Aristocrats, 57 companies that have been increasing their dividends for 25 plus consecutive years, has largely outperformed the S&P 500 since 1991. And since 1960, dividends have accounted for 33% of the total return of the market. An investment today could just be your passive dividends paid out 10-15 years from now. Long story short, I hold all of these companies shown here that I buy and hold indefinitely. All of these companies were specifically researched and chosen, whether it's a high yielder for current dividend income or low yielder with high dividend growth increases for future passive income. You can view the rest of my M1 Finance portfolio using the link below. I'll also include a referral link where you and I can both earn $30. This special referral program ends this month, so act fast. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take this information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. I am just an ordinary guy posting his opinions onto YouTube because I love dividends, stocks, and personal finance. If you found this video helpful, please consider clicking the like button and subscribing to my channel. This helps with the YouTube algorithm and gets my channel noticed. Hit the bell notification to receive the latest alerts, and all engagement is much appreciated. Take care.